Okay, so I've talked about financial plans, what they are, how they fit into the bigger picture. I've talked about basic accounting principles. I've talked about the landscape in terms of legislation and tax laws, and talked about broadly our responsibilities as managers around financial element of our role, or financial management of our role. I now want to dig down into budgeting and forecasting because I've been talking about budgets, I've been talking about forecasting, but I really want to talk about how that happens and what that is. So, budgeting occurs usually within a specified future period, and the organization, depending on the nature of the work that you do and the organization and its reporting requirements to other key stakeholders, our budgets will span time periods mainly 6 monthly, half yearly, and 12 monthly, yearly. In some cases, also quarterly. So you'll have quarterly budgets, half yearly budgets, and yearly budgets. And those budgets will set out what has been allocated in terms of revenue raising and what has been allocated in terms of expenditure. And those numbers are tied in to bigger plans. So going back to that big picture stuff. So if we're forecasted to spend to raise $1 million in the financial year, and there's 12 different operational centers, then the business will set all their business plans for the next 12 months on the premise that we're going to generate $12 million. And if we then budget that we're going to spend 100,000 in expenses, and there's 12 operational areas, and everybody's going to be budgeted for 100,000, the business will bank on us having an expense over the next 12 months of $1,200,000. And if that means that after all sales, gross profit, expenses, and any other costings are taken out, if that means that each operational area is going to make $20,000 in trading profit, bottom line profit, and there's 12 operational areas, well, that means we're going to make 240,000. We're going to forecast 240,000 of profit. So the business is banking on us making just under $250,000 of profit for the year in the operational areas. So that will reflect all our plans. It will reflect things like our cash flow budgets. It will reflect things such as our capital expenditure for the year. It will reflect on things such as our marketing and advertising plans and so forth. So budgets are really forecasts of financial performance over a specific time period, a locked-in time period, be they quarterly, half yearly, or yearly, as I said. And often we're asked to provide input into that. In some cases, we may be asked to develop them from scratch, but most commonly, the business will say, "Tony, here's your budget. You know, we're expecting uh, as a business a 3% growth, and that's the baseline for the budget from the budget change from last year. So you might have a 3% baseline on sales growth, and then a scaled version of that in terms of expenditure increase, and then you'll have input to how you shape that. So you might go back to your team. Well, I'll talk about consultation soon, but ideal scenario is that you go back to your team, you talk to your team, you look at your own team plans for the next 12 months, you look at any other factors that will be influencing things such as sales and expenditure. So you'll look at, for example, your team, how secure it is, whether you need to recruit, whether you need to invest in training. You look at your equipment, see how it's fit for purpose, and make decisions about whether there's some maintenance is required or any other expenses that you identify from that. You'll have a look at what's happening in your community and how that's going to influence the forces on whether your revenue is going to be up or down, for example, COVID and so forth. You'll think of all these things in consultation with your team, and you'll make recommendations around shaping that budget. that's the normal process. And again, it changes depending on the business size of your business, whether you're a small owner operator or whether you're a large um, monolith of a multinational. That those things will change, but generally speaking, that's pretty much the rule of thumb of what occurs. So that's the budgeting process. The forecasting process is what goes on within that designated time period. So we have let's say we've got a 6 month budget that we've set out. We've had input from our team, we've shaped it, we've gone back and forth with our manager with some of our recommendations, but they've finally signed off on a particular budget for the next 6 months. As we go through those 6 months, we'll be asked to most frequently be asked to forecast going forward. So what's my forecast for the next month or next week, next fortnight, next month, and so forth. So forecasting allows us to then make little micro predictions within our, our, our designated budget period. So we look at current trends and we use those trends to forecast whether things are going to be up or down or whatever the case may be. So because things constantly pop up, and it's the nature of business, it's the nature of going about business. So in the forecasting, we often think about big picture, the budgets. We look at what the organization is doing. We look at what's happening socially. We think about contingencies in the budgets, but we most commonly think about contingencies as well with forecasting, because we start to get a more micro perspective of things that are currently affecting our business and our operations. And just sort of again, just to touch on some of those things that we'll see within our budget. So the revenue are often the sales that I was talking about. So if I go back to some of those profit and loss statements of earlier, and I know I touched on this, but just want to make this clear because it's pretty important. Revenue is any money, any income coming in. So revenue is often referred to as sales, is the general the amount that we get over the counter. So if we sell coffees for $5 each and we sell 100 coffees, our revenue is $500. But then we can talk about gross revenue or gross profit or gross sales, depending on again the nature of the business and what we do and how we report on it. But whenever we talk about gross, we talk about, and not gross as in you, but gross in finances, we talk about the revenue or what we get out of that dollar in sales, that revenue, what we get out of it once we take out the cost of making that sale. So if an example I use here, so if we sell coffees for $5, that's revenue. However, each cup of coffee costs us $2 to make, and it might be, let's say there's the cost of bean in that, the cost of the cups that we use, or the cost of the milk or any other stuff that goes in there to actually make that sale. In this case, the production of that product. Then that comes off our revenue and it gets reported as either gross revenue or gross profit. And in this case, our gross revenue or GP or gross profit is $3. So from $5, what we get in our hand, that $5 note, the actual what we actually made from that sale is $3 because it's cost us some of that $5 to actually make that sale, if that makes sense. So that's when we talk about revenue and gross revenue or gross profit. Then under that, we have our net revenue. And net revenue, or trading profit, as it's often called, is the profit that we make from our gross profit or gross revenue after we take out all running expenses. So wages, utilities, advertising, leasing, all that stuff I talked about earlier comes off our expenses. So once we take our expenses from our gross revenue or gross profit, that's our trading profit or our net revenue. And sort of just if I can break down in revenue, just while I'm talking about revenue, businesses will often, the majority of the business money or revenue will come from the core business. So in this case, if we're a coffee shop, Our operating revenue will be coffees, muffins, sandwiches, anything, drinks from the fridge, anything that we sell will be in that operating revenue or operating money that comes out of it. Uh, Goods or services. For some people, like if we're in the rental business, our operating revenue will be from the rents that we receive because that's the core business. If we're a consultancy business like Macmillan, then from the consultancy services, we go out, we deal with clients, we send an invoice that we would call operating revenue. But businesses also have non-operating revenue, so there is other revenue streams as well, which we don't necessarily, from an operational perspective, we wouldn't necessarily see these come up in our budgets, not within our scope of accountability, but just a more of an awareness thing. Um, there are other streams of revenue for businesses that are non-operating. So this is money that is made that is not from the core business. So it's generally not reoccurring by nature. So this might be, we might make money from sale of assets, for example. So we might get rid of some old fit-ins or old stuff, and that might be just non-operating revenue. Most commonly, though, it's things such as we might have some investments outside of our core business. So we might have some shares, and we're getting some dividends from that, or it may be that we've got a lot of cash and we do short-term investments and derive some returns from that. So these are all examples of non-operating revenues or just alternative revenue streams which are not part of our core business, and they usually get reported at a different cost center to ours. So that's revenue. So let's break down costs. Costs can be, so when I talk about costs, I'm really talking about the expense line here. Costs can be direct or indirect. So direct costs are things that are really obvious. So salaries, materials, supplies, equipment, travel costs, contracts or supply costs, and so forth. But there are also indirect costs. So things such as things that aren't so obvious because we might not necessarily see them as obvious as some of these other ones. Sometimes they happen in the background. We don't even know aware of it, especially if you're working within larger organizations. You may not necessarily see the invoicing for office spaces or general supplies or costs of furniture or fixtures or the equipment that you're using, the IT equipment and the software licenses that are used within that. Or general administrative costs. So if you're in a large organization, we're in a multinational, and I'm operation. I go back to that. I'm operating the ACT area, and there's a head office in Sydney. Someone's got to pay for that head office because that head office might not be running the revenue, so they might distribute that out amongst all the different locations and sites, and that would be an indirect cost as well. Or you might have people within your team who aren't necessarily revenue raising. They may be playing a role in the background in administrating, like such as accounting and legal, which aren't generally revenue raising activities. So they might be some indirect costs as well that we need to absorb within our profit and loss statements. So there's just some things to think about in terms of direct costs and indirect costs. And that can also be tangible and non-tangible. So tangible things that are physical, non-tangible things that aren't physical in terms of cost. So rental space is definitely tangible. Insurance may not necessarily be a tangible; it's an intangible. And then we have recurring and non-recurring costs. So recurring costs are things that are cyclical by nature that keep popping up. So rent. Utility costs, salaries are cyclical and reoccurring. As I said, insurance, those type of things, lease arrangements, all these things are locked in for the next 12, 24 months. So they'll be reoccurring costs. Others are non-reoccurring. These are one-offs. Usually things in the CapEx budget are non-reoccurring, so they might be specific investments. Non-reoccurring can also include things such as severance pays that are not necessarily planned for or cyclical by nature. Write-offs, I talked about, we might have to sell assets that we bought at a higher price and now are significant lower. We have to account for that. losses from sale of assets, unexpected legal costs that pop up, unexpected pandemic costs, for example. These are all examples of non-reoccurring. So when we're thinking about our costs, especially when we're influencing the budget and forecasts, we're thinking about costs that are reoccurring, things that we predictable. So we can look back over the last couple of months and see that these are reoccurring costs, and we can predict those with confidence going forward. But then we also need to think about the non-reoccurring stuff, the stuff that we don't necessarily have a historical evidence of because it's not reoccurring. So you have to look a bit closer to see if there's anything on the horizon that might pop up, which is a one of nature that doesn't surprise us if we miss it. And then once we identify these costs, obviously there's an element of trying to identify how much these costs are going to be specifically. And there's no general rule or principle for determining costs other than making sure that we try and identify all the costs, like as I mentioned, direct, indirect, the things that are occurring, non-recurring, making sure that we also identify what's allowable and what's non-allowable. So for example, there's allowable from a business perspective, things that they will allow us to spend money on and that they will approve the purchase of or the ongoing payment of. And there are things that the business won't allow. So things outside our scope of delegation of making decisions on or that might not necessarily be considered essential to the business. But it's also allowable and unallowable within, say, contract arrangements. So you might have suppliers that our contract arrangements allow them to charge us for stuff, not charge us for other stuff. When we're thinking about budgeting and determining costs, that there's a uniform approach. So the way that we determine costs is uniform across as much as possible across the whole expense line, so that if it's historical, and I'll talk a little bit about approaches, but if it's historical, that we're using historical as much as possible and so forth. Not that we're historical and then gut feeling on another one. We also think about the distribution base. If it's something that we're going to use over the 6 months and it might be charged at different points, how are we going to distribute that over the time of the budget? And what do we consider to be contingencies? Again, I'll talk about contingencies shortly. What do we consider as contingencies and how do we factor those into our budget and forecasting? And then, are we working within the agreed standards of financial management for our organization? So things like, collecting receipts, recording and reporting and so forth. And I don't want to spend too much on this, but just to sort of point out, there are some tools that we can use for estimating costs. Some of these are more accurate than others, and I've put these in hierarchy of the most accurate to the least accurate. These are really important as well in things like project management spaces. So bottom-up estimating is the most accurate way of determining the cost. That is where you look at an activity and you break it down to its most minute detail, and you work out at each minute point or task that has to be done within the activity, how much that's going to cost. And you do your research on that, and you then collate it together to get an aggregate cost for the total activity, and then that becomes the cost of doing that thing. So if we don't have historical evidence, if it's not a cyclical cost, it's not something that is, in a contract for the next 2 years, and it's a one-off that we're trying to determine a cost on it. This we would plan that activity, we would break it down, we would attribute a cost to each of the tasks or small steps within that activity to try and get a really accurate picture of what the total activity is going to cost us. If we can't do that, there are other methods. So for example, the 3-point estimating method, which is one of the common project management tools used alongside the PERT method, looks at things like the most pessimistic cost, the most optimistic cost, and then uses a formula which is your expected cost is going to be your most optimistic cost plus 4 times what you think is the most likely cost plus 1 time what you think is the most pessimistic cost, and then you divide that by 6 and it gives you um, a figure that that can be used as a somewhat or as a fairly accurate tool in terms of determining the cost. So it just looks at the balance, the probability of balance between pessimistic and optimistic. Then as we go away from that, we have a parametric, which is we can use a historical data to calculate cost estimates, not in terms of cyclical stuff, but in terms of, it might be something that's happened in the past a couple of years ago, and we can sort of try and factor in some, you know, indexing for that, or it might be that another organization has done something similar, and we can use that as a basis of historical data to make cost estimates. And then the least effective is where we go totally analogous, and that's where we look at something similar that it's completed by our organization, or sometimes you can go outside your organization, but something similar, and you try and base it on that. So there are different ways that we can approach trying to clarify costings. Not a big part of this unit, but just sort of to give you the heads up on some of the tools that are available. So we've done all that. We understand the budgets. We've understand the parameters of the organization. We've consulted with our team. Then what are some of the guidelines that we should be following for effective budgeting? Well, just to sort of frame these up, some of the key guidelines that we should be following when effectively budgeting is making sure that we consult widely. So the quality decisions that we will make will be based on the quality of the information. The more that we consult with the right people, the better the information that we'll get, especially on frontline people who are doing the job and will be able to tell us things that will affect performance. If we consult with those people and those people are helping us shape the budgets and forecasts going forward, we're going to get some positive byproduct, and that positive byproduct will be good information, number one, help us make better decisions. But two, we're going to get buy-in. So it'll be an education process. So if we're sharing our budgets with people and we're consulting with them, they're learning about what the financial expectations, and then that'll help us in terms of communicating stuff as we go through our operations. So yes, we can do that because it's in the budget. No, we can't do that because it's not in the budget. We were part of that. We didn't forecast this, so we're going to have to wait, and so forth and so forth. Makes those conversations a lot easier. It also has that sense of buy-in and motivation that people get from that buy-in, that commitment to what we're doing. And it also it helps us to be realistic. So if we consult and we bring people involved within that, it's going to be we're going to get a more realistic, and that's another part of our guidelines. Just making sure that the objectives that we set in the budgets should be obtainable and realistic. They really need to be something that we think we can get, because if it's too pie in the sky, we won't even try. So it needs to be we need to be confident that we can get it, and we need to be confident that it's worthwhile pursuing. And if we can communicate those things, the fact that they're obtainable and realistic, in line with what we're trying to do, and that they're worthwhile pursuing, that we're going to really get people to buy in and be motivated to that as well. And then the other important element within effective budgeting is making sure that we're constantly going back and evaluating and analyzing and looking for opportunities to improve. And that's tweaking becomes really important. This is the role of forecasting as well, that you're constantly tweaking going forward so you can make adjustments to stay on track.